Hi, and welcome to ArcisFX. I'm James, and I've been a fund trader for about 20 years. It would really be helpful to me if you press the like button just to support the channel. And also, if you subscribe to the channel, you'll get videos as soon as they come out, and you'll get notified by email and by telephone. See you on the inside. This video is an introductory video about candlestick charting. And it's the first of a 7-video series in which I'm going to be describing what candlestick charting is all about, and I'll go through some of the most important candlestick charts and the patterns and how to use them. Pause and have a look at the patterns as we go through them, because this is going to be quite quick. We'll go into them in more detail in the subsequent videos. Go and switch on your Google and go and have a look at some of these patterns on Google and read a little bit more about them in order to prepare you for the next videos in this series. This is taken from a book I wrote a long time ago, and let's just start with the first section, how to read a candlestick chart. Well, this is the most important part, and this is just a brief introduction, and I'll explain to you where you can get more resources on this towards the end of the series and probably at the end of each video. Basically, a candlestick chart looks like this, or a pattern looks like this, and it looks like a candle, actually. That's why it's called a candlestick. And it's formed by the open price, the close price, the high price, and the low price of a particular trading period. That could be a 5-minute period, could be an hour period, a 4-hour period, a day, a week, whatever period you're looking at on your charts. This represents that entire period. And for example, if this was an hour chart, and we were looking at hourly candles, in this hour, this one on the left, the red one, the market will have opened at that price where the arrow is, moved up or down to the high and the low price, and then closed at the place where it says the close price. And that forms what's called a bearish candle. A bearish candle is when the close is lower than the open, and it's really irrelevant in terms of whether it's bullish or bearish, what the spikes look like on the candles. And it's drawn like this so you can easily visualize what happened during that period with the price action. So we can see that we opened there at some stage during that hour. I'm going to use hourly as an example in most of these because that's the main sort of chart pattern I trade, hourly and daily candles. And we'll talk about that a little bit as we go through. But in this hour, the price at some stage touched that high, and at some stage touched this low, whatever that price might be. But we do know for certain that it opened at that price and it closed at that price. Similarly, a bullish candle is the inverse to that. So we open at a lower price than we close. So we opened down there, we closed up here, and at some stage during this hour period, the price reached a high of the top of this, what's called a wick of the candle, or the spike of the candle, normally called a wick. And at some stage during that hour, the price also touched the low part of this candle, the lower end of the lower wick. So that's really what a candle looks like. A candle tells you 4 things: the open price, the close price, the high price, and the low price. And you get bullish, this one on the right, and you get bearish candles, and that's what they look like. Now, we're going to go through a few of these, and because they're on the video screen, it's easy for you to pause and read through some of these things. So I'm not going to go through them very fast. I'm not going to describe how to use them or anything in this introductory video, but we'll go into those matters in detail when we get to them. So this is called a piercing pattern or a piercing line. It's a bullish pattern, and the first candle is a long bear candle. That's this one, followed by a long bull candle. The bull candle opens lower than the bear, then the bear's low, but closes more than halfway up the middle of the bear candle's body. Now, this is a pretty important candle pattern. It's one I like very much. We'll come back to that in subsequent videos. Piercing pattern, very important candle pattern. Keep that one in mind when you're looking at your charts. And we've got a hammer candle, this one here at the top. It's a bullish candle pattern if it occurs after a downtrend. It's actually a bearish candle pattern at the top of an uptrend. In that case, it's called a hanging man. And you'll see sometimes, not often, we get beautiful hanging man examples on Forex and stock and metal and commodity charts, and they're very tradable, particularly at the top or the bottom of a trend. So we'll come back to those. And it's called a hanging man because we've got a small body and a long dangly wick when it's at the top, or a hammer. So some people call them hammers, some people call them hanging mans when they're at the top. Sometimes people at the bottom call them inverse hammers. We'll cover all of that in detail. Don't worry about it too much now. Morning star. Well, we get a bearish candle followed by this little candle. It's a star because it's very small, and then we follow that with a bullish candle, and it forms this sort of U-shaped bottom. If this was an hour chart and you looked on a 5-minute, you would see a U-shaped bottom, which on the smaller time frames and even the longer time frames is a bullish reversal pattern. But when you translate it into hourly candles, we'll get something like this. So we'll get a bearish candle, a long bearish body, followed by the star. The star simply means it's a small, tiny candle pattern with very small wicks and a very small body. And then a long bullish candle, that's a reversal pattern. Bullish engulfing, they call it lines. I translated this from a book by Steve Nisson. It's actually a book which I have had in my library for a very long time. I would just call that a bullish engulfing candle. Basically, we get a bearish candle, which then moves even lower, and then it moves higher, and the body of the bullish candle completely engulfs the body of the bearish candle preceding that. It's called a bullish engulfing pattern or line. Very important candle. It's very tradable indeed, something that you need to keep in the back of your mind. Here we get a bullish doji star. Now, doji simply means, it's a Japanese word, simply means that the open and the close of the candle are at the same level, and therefore you don't get a body or a real body. It's a very skinny, tiny little body, which is just really a line. It doesn't really matter if it's slightly filled out, but more or less a doji is when the open and the close are exactly at the same price. That's normally a hesitation candle, not as tradable as some of the others, because it's sometimes just a hesitation or a point of indecision in the market. It doesn't necessarily mean a reversal, and that's why it says here you should wait for a confirmation before trading a doji star. And the sort of confirmation you'd want from a doji star, we can have a look back up here, is a doji star pattern where instead of that morning star we have the doji star like that, followed by a bullish pattern, a bullish candle with very small wicks and a big bullish body on the candle. We've got a long bearish candle. Well, that's pretty easy to determine. Very big body, very tiny wicks, basically full-on bearish candle. A dark cloud cover, that's another one that I want you to remember and think about and have a look for all of these on your charts actually. It's a good opportunity after this video to go to your charts, go through these, do a bit of Googling, and see what you can find on your charts that look similar. Now, I'm going to be telling you how I trade these in conjunction with other things on your charts. Some people trade them as standalone patterns without anything else on their charts, and that can be done, and I do that myself sometimes. But these become very powerful when you combine them with things on your charts that are helpful, like support and resistance lines, trend lines, Fibonacci levels, and even certain moving averages which act as support and resistance. So bear that in mind when you're looking at candles. Dark cloud cover, this one, as I said, keep this one in mind as well. A pretty important candle pattern. We'll come back to these all. Don't worry about it. There's a bearish engulfing candle. This is very similar to the bullish engulfing candle that we saw earlier, except it's the other way around. We get a bullish candle and then a bearish candle where the body of the bearish candle completely engulfs the body of the bullish candle. That's the key to it. That's why it's called an engulfing candle. And as it says here, this pattern is strongly bearish if it occurs after a significant uptrend. And you'll often see these at trend reversal areas on your charts. They're not infallible, but very, very good. One of my favorite candle patterns, engulfing candles, engulfing lines, call it what you want. Hanging man. Now, we'll talk about this one in more detail. It's a hanging man. It's a double hanging man. It's actually a tweezer top and a tweezer bottom. We'll talk about tweezers as well. I'm not sure if these are mentioned here, but remember, hanging man, we talked about the hanging man earlier. It's actually a hammer candle, which is at the top of the trend. We've got the small bodies and the dangly legs. That's how you know it's a hanging man. Small body, dangly legs, much like a human body, I suppose. Our legs are longer than our torso, I think. And that's why it's called a hanging man. But when, and keep this again in mind, when the bottoms of any candles, particularly tweezer bottoms like these ones, or the tops of any candles are at identical prices, it's a very powerful reversal signal. particularly when used in conjunction with other methods on your chart, like I described earlier, such as horizontal lines, trend lines, Fibonacci's, moving averages, and so on. The other thing you can do with all of these is time your entries using a stochastic. Now, I'm using a lot of this information from my G7 trading system, which I will mention. This book that I'm reading from right now is actually my G7 trading book, which I wrote about 20 years ago. So I'll see if I can make this book available to all of the people that subscribe to this channel. So if you haven't subscribed, you won't be able to get access to this book. There's a bribe for you, isn't there? Evening star, we talked about a morning star. Well, an evening star is the same thing. We've got a bullish candle, big body, small wicks, followed by the small body, small wicks, that's the star, followed by the bearish candle with a big body. This one's got a slightly longer wick. Doesn't really matter, but it's that U-shaped top. We looked at the U-shaped bottom. On the smaller charts, it'll look like a U. On the hourly charts, in this case, it looks like this evening star pattern, and it potentially signifies a top. Doji star, very similar thing to this. We had a look at the morning doji star. This is the evening doji star. Remember, a doji is when the candle price or the market price opens and closes at the same price. If you go back to the beginning of this, you'll remember that the opening and closing prices form the shape of the candle along with the highs and the lows. So if the opening price and the closing price are identical, you will get a line there and not a body like we see on that candle. Doji, told you about dojis and indecision. Don't rely on dojis for reversals, even double dojis. Sometimes you get 3 or 4 in a row. It doesn't mean that the market's going to reverse. Be very careful of these. Some people will tell you when you see a doji, it means a reversal. That is not the case, not at all. Harami, well, this is the opposite of engulfing pattern. It's called an harami, but stock traders and more contemporary traders might call this an inside candle or an inside bar. It's the same sort of thing where the body of the subsequent candle going forward in time, so that was the previous candle, this is the current candle, the body of that candle, this one here, is engulfed by the body of the preceding candle, so it's the opposite of a engulfing pattern. So harami or inside candle, and it implies a decrease. Sometimes these take place at reversal points as well. Long-legged doji, same as a doji, opening price and the closing price are the same, and you've got to be a bit careful with these. They do signify turning points or points of indecision, but they're not as reliable as some of the other candles. Gravestone doji, we'll come to this. This is a really good one, particularly when it's combined with one in the opposite direction following it or before it. So when you get I call it a one up, one down, a spike high followed by a spike low, or a spike low followed by a spike high with small bodies. Very important pattern. We'll cover that. Stars we've talked about, and that's it. And then the rest is all about the G7 trading system. So that's just an introduction. You can go through some of these, and as I said, just slow this video down, have a look at some of these patterns, and go and do some Googling. Well, that's the introduction to candlestick charting. I'm going to be giving away a copy of this G7 ebook. It's 49 pages. If you do subscribe to this channel, you can perhaps get hold of this book. I'll do a draw at the end of the series. Take care, enjoy it. Look forward to the next video. It'll be coming out shortly.